Internal control is a fundamental element of corporate governance and financial reporting, providing reasonable assurance that an entity achieves its operational, reporting, and compliance objectives. ISA 315 identifying and assessing the risks of material misstatement requires auditors to obtain an understanding of the entity's system of internal control to identify and assess risks that may lead to material misstatements in the financial statements. A well-designed internal control system safeguards assets, promotes operational efficiency, ensures compliance with laws and regulations, and enhances the reliability of accounting information. For auditors, understanding internal control is essential because it directly influences the assessment of control risk, the overall audit strategy, and the nature, timing, and extent of substantive audit procedures. Strong controls may permit greater reliance on the client's systems and reduce substantive testing, whereas weak controls generally require more extensive audit procedures and larger sample sizes. The auditor's understanding of internal control extends beyond documenting accounting procedures and includes evaluating whether controls have been appropriately designed and implemented. The objective is not to express an opinion on the effectiveness of internal control but to determine whether the system is capable of preventing, detecting, or correcting material misstatements on a timely basis. During the planning stage, auditors obtain knowledge of the entity's governance structure, organizational policies, information systems, business processes, and risk management practices through inquiry, observation, inspection of documentation, walkthrough procedures, and analytical review. This understanding provides the foundation for identifying significant audit risks and designing appropriate audit responses in accordance with a risk-based auditing approach. The control environment represents the foundation of the internal control system and reflects the organization's overall attitude toward governance, ethics, accountability, and internal control. It encompasses management philosophy, ethical values, organizational structure, assignment of authority and responsibility, human resource policies, competence of employees, and the oversight provided by those charged with governance. A strong control environment promotes integrity, transparency, and compliance throughout the organization, reducing opportunities for fraud and error. Conversely, weak governance, poor ethical culture, excessive management dominance, or inadequate board oversight may significantly increase the risk of material misstatement regardless of the existence of individual control procedures. Auditors therefore evaluate the control environment carefully when assessing overall audit risk. The entity's risk assessment process is the mechanism by which management identifies, analyses, and responds to business risks that could prevent achievement of organizational objectives or result in material financial misstatements. Effective risk assessment involves identifying internal and external risks, evaluating their significance and likelihood, and implementing appropriate responses to mitigate those risks. Examples include technological change, cybersecurity threats, changes in legislation, supply chain disruptions, foreign exchange exposure, or new accounting standards. Auditors consider whether management has established appropriate procedures for identifying and managing such risks, as deficiencies in the risk assessment process may indicate weaknesses in governance and increase the likelihood of financial reporting errors. Understanding management's risk assessment process also assists auditors in identifying areas requiring enhanced audit attention. The process to monitor the system of internal control ensures that internal controls continue to operate effectively over time and remain responsive to changing business conditions. Monitoring activities may include ongoing supervisory reviews, management oversight, internal audit reviews, periodic reconciliations, exception reporting, quality assurance reviews, and corrective action procedures. Organizations with effective monitoring systems identify control deficiencies promptly and implement timely remedial actions, reducing the risk that weaknesses remain undetected. The existence of an independent internal audit function often strengthens monitoring by providing objective evaluations of internal controls and risk management processes. Auditors assess monitoring activities to determine whether controls are likely to operate consistently throughout the financial reporting period and whether identified deficiencies are appropriately addressed by management. The information system and communication component encompasses the procedures, records, information technology systems, and communication channels used to initiate, record, process, summarize, and report financial transactions. Reliable financial reporting depends upon accurate recording of transactions, appropriate authorization procedures, complete audit trails, effective system security, and timely communication of relevant financial information throughout the organization. Communication should flow both vertically and horizontally, ensuring that employees understand their responsibilities while management receives timely information regarding operational performance and control deficiencies. Modern organizations increasingly rely on integrated information systems and automated controls, making information technology governance and cybersecurity significant considerations during audit planning. The final component, control activities, consists of the specific policies and procedures implemented to ensure management directives are carried out and identified risks are mitigated. Control activities operate at all organizational levels and include authorization procedures, segregation of duties, physical safeguarding of assets, reconciliations, supervisory reviews, performance reviews, access controls, arithmetic checks, exception reports, and automated application controls within information systems. Effective segregation of duties ensures that no individual controls authorization, recording, custody, and reconciliation functions simultaneously, thereby reducing opportunities for fraud and error. Preventive controls seek to stop errors before they occur, while detective controls identify errors after occurrence and facilitate corrective action. Auditors evaluate the design and implementation of these controls when determining whether reliance on internal controls is appropriate. The 5 components of internal control operate as an integrated framework rather than independent elements. A strong control environment supports effective risk assessment, monitoring activities reinforce control effectiveness, reliable information systems facilitate communication, and control activities address identified risks. Weaknesses in any component may undermine the effectiveness of the entire system and increase the risk of material misstatement. Consequently, auditors assess all 5 components collectively when evaluating control risk and designing audit procedures. A comprehensive understanding of internal control enables auditors to adopt a more efficient and risk-focused audit strategy while enhancing the quality of audit conclusions and supporting confidence in financial reporting.